Hello, welcome back to my YouTube channel. So today we will be talking about how I would invest in 2024. And one of the easiest ways you could do that is through index funds. So let's dive right in. What I would like to start off with is the world's best investor, which is Warren Buffett, and his recommended strategy. So basically, for an average investor, Warren Buffett recommends that you should invest in an index fund. In 2007, he offered a challenge to the investing industry, saying that an index fund would outperform any actively managed funds over the next 10 years. Ted Seises made a famous bet with Warren Buffett and took this challenge on. Ted focused on actively managed funds, whilst Mr. Buffett just brought a S&P 500 index fund and sat on it for 10 years. Over the next 10 years, the returns were outstanding. Ted's active fund returned approximately 36% on his capital, whilst S&P 500 index returned a whopping 125%. This just goes to show that, an index fund is nothing to be sniffed at. It is one of the best ways you can invest your money in, especially for an average investor who doesn't really know how the stock market works. It's not just about looking at the company. There's lots to it, and the variables are, I would say, probably infinite. So therefore, as Mr. Buffett recommends, we should all invest in an index fund. So with that said, let's go into the topics that we'll cover in this video on how I would invest my money in 2024. So firstly, we will look at what is an index fund. And the benefits of an index fund that one can have by choosing an index fund. How to choose a good index fund. So what makes an index fund? What is the benefits? What's the positives? How to buy your first index fund through whatever platform you're in. And fifth point is, things to consider when buying index funds. So what is an index fund? An index fund is a type of mutual fund or an exchange-traded fund that is designed to replicate the performance of a specific financial market index. This tracks the returns of a particular benchmark index as closely as possible. And these benchmark indices could represent various segments of the financial market, such as overall stock market, specific sectors, or even asset classes. The best example I can think of in comparison to an index fund is, imagine you are a farmer's market, and instead of picking and choosing your own fruits, you basically can just choose a fruit basket with a combination of fruits, and therefore eliminating the process of picking which fruit is best for you, and you just buy a basket with fruits that is already built in for you. So you basically buy a certain index fund which buys all the companies within it. In contrast to an actively managed index fund, where basically a fund manager will take your money and then pick a certain stocks to do well or outperform the market. The second benefit is diversification. So you've got basically a broad spectrum of industries, sectors, districts where your money is distributed to. So diversification is key for the average investor, basically. Broad market exposure, so this also helps you to spread your risk across a diverse range of securities within the index. This diversification is inherent in the index's composition. The third benefit is that it's low cost, low fees compared to an actively managed funds. The index funds can be as low as 0.06%. An S&P 500, for example, the world's most famous index fund, I would say has a fee of 0.07% on most platforms. This means that you get a higher net return over a long period of time. So if you're like me, investing for the next 10, 20, 30 years and want this money to work for you, then this probably is the best way you can invest your money passively without doing much. It's transparent, so the holdings are transparent, where investors can easily find out the information on the securities included in the fund and the respective weights within the index fund. So there's no hidden nothing hidden from you. Everything's transparent. You can go in and look at whatever funds you're investing in, the distribution, the allocation, etc. The next thing is market cap weighting. So many index funds use market capitalization weighted approach. What this means is that basically they weight their market capitalization, so larger companies have a higher impact on the fund's performance under this method. So for example, in S&P 500, if you invest £100 per month, £29 at the moment are allocated to information and technology sector. So this includes your Google, Tesla, etc. The next point is variety of indices. So index funds can track a wide range of indices covering different asset classes such as stocks, bonds, commodities. Basically this depends on the individual and what you want to invest in. Investors can choose their funds based on their own goals and also their risk tolerance. The last point I would like to mention on the benefits of index fund is basically this is a buy and hold strategy. So you capture the market overall market's return over a long time rather than trying to time the market or make frequent trades. So you're basically saying I have £100 spares every month after paying my bills, having a bit left over for enjoyment. I want to save a bit for the future in addition to my pension. So what you're doing is every month you buy £100 of an index fund, and you do that over the next 5, 10, 15 years, and you will see a positive trend, hopefully. Now obviously investments can fall up and down and your capital is at risk, but over the history of investing you can see that the trend line is normally always going upwards, but please do your research before investing. Some of the popular indices that serve as a benchmark for index funds include the S&P 500, like we've said, the Dow Jones Industrial Average, and the Nasdaq Composite for US stocks. Internationally, indices like the MSCI World or FTSE All World are commonly used. In fact, I use the FTSE All World now. I used to have funds in S&P 500 and Life Strategy 80/20, which is one of the funds on Vanguard. I've sold them all and I've invested into FTSE All World just because I think it's simpler, and it as we've sort of said, in market capitalization, so it invests in the US as well as the UK and any other emerging countries. It's important for investors to select the right index fund, that aligns with their investment objectives and their risk tolerance and their time in the market. So what I mean by that is, are you a 50-year-old? Are you a 20-year-old? That has a huge difference between the way you invest and the risk that you may be willing to take. Now, I'm not a financial advisor, but the younger you are, the more beneficial it is for you to start investing now, and you will get a better return over the next few decades. So how do you choose a good index? Well, basically this depends entirely on you, your risk tolerance and your position. For me personally, I like to invest in the whole world through All World Index Fund. Vanguard FTSE or Global All Cap Index Fund is a good one. Popular index funds are, as we've said, S&P 500, FTSE 100 in the UK. Index funds are by far the best way to invest for the average investor. It reduces your risk to individual companies. You get the average gains over the long period of time. The S&P 500 has returned on average, I think 10%, just over 10% over the last 50 years or so. So by investing in an index fund, you are filtering your gains and your losses. What I mean by this is, if you invest in a single company, let's say Tesla, yeah, sure, you can get massive returns, but then when or if Tesla happens to go down, then you will also get massive dips in your portfolio. So if you invest in an index fund, you basically average out your wins and your losses, and hopefully over the next 5 years, 10 years, the average will be 8 or 10% gains per year. And this means that you're spreading your risk across, if it's S&P 500, then you're picking 500 best companies which the index selects for you. So you're not risking everything. don't keep all your eggs in one basket, as the saying goes. So how to buy your first index fund. So before you decide your first index fund, here are some things that one should consider. So one of the things I always say to anybody is, pay off all your high interest debt. So this is excluding your mortgage and perhaps your student finance if you're in the UK. In the US, this is a different game. So depending on your interest rates. Next thing you want to do is choose a tax efficient means of investing. So in the UK we have a stocks and shares ISA, which gives us up to £20,000 per calendar year allowance to invest. If you're in the US, you've got Roth IRAs and Roth 401ks. So check your country, check the rules, make sure you are investing in the most tax efficient way as possible. Because over the next 20 years, 10 years, 20 years, you could get massive gains and you don't want to be paying tax on that. The third point that you would want to consider is basically choose the platform, investment platform. So is it reputable? Has it got protection? In the US, we've got the Financial Services Compensation Scheme. What investments they offer. So for example, on Trading 212 or Free Trade, you can pick and choose your stocks. Whereas on Vanguard, you've got your specific indexes or your life strategies, etc. So know what you're in it for. Some good platforms, in my opinion, are Vanguard, Fidelity, Invest Engine, Trading 212, Free Trade. Check out the video description, and I've got some links to these platforms. Some of them are affiliate links, so if you invest certain money, you get free stocks, free shares worth up to £10 to £50. And if you use my code, then I will also get a certain money back. So that would, if you want to invest in Invest Engine, that's linked below. So how to buy your first index. So basically, Invest Engine is the chosen platform that I will publish my videos on. The investment journey that I want to show on YouTube, where basically I want to show the viewers, you guys, the ups and the downs of investing, and I want to be completely transparent in this journey, and I will take you through the positives, the negatives on a monthly basis, and why I choose what I choose, so you can see for yourself the advantages, the disadvantages, the good, the bad, the ugly of investing. So follow the steps required for whatever platform you choose to invest in for yourself. Whether it's on Vanguard or Invest Engine or Trading 212, typically you will need to provide the following if you've not got on stocks and shares ISA yet. Your obviously email, your mobile number, NI number, bank details, so you can transfer your funds across to buy some investments. The next point is whether you want to set up a direct debit or standing order, or do you want to go in and actively put a certain money every month. What I tend to find is that if you have a standing order, which I've got for over 2 years now in Vanguard, it's set and forget. So I invest £200 per month, my wife invests £200 per month, and that's it pretty much. Set and forget strategy, we've been doing that for the last 2 years, and I think that's probably the best way the average investor can do. Now I understand the irony of this, but as I'm making a YouTube channel on investing and I'm showing you my journey, but this is obviously to get the good into the market. I don't think enough people understand what stocks and shares is. I don't think enough people understand what investing is. I don't think they understand the benefits and the risks of investing. Obviously we've got the pensions, but I think this is another vehicle, a good vehicle to fall back on before your pension age, should you need it. On some of the platforms you can start with as little as £1, and on others, established platforms like Vanguard, Invest Engine, you can invest a minimum of £100. If you invest £100 from the age of 20 to the age of 65, with let's say an average gain of 10%, you would end up with over £1 million in your portfolio. Now that's quite significant for a small amount of money that you sacrifice, and you don't even, you may not even notice that £100. So here are some things that you should consider before you invest in a fund. So one of the first ones is fees. So index funds are cheap compared to active funds. Index funds typically have a fee of 0.06 to 0.2%, whereas In contrast, actively managed funds fees can be up to 1.2%. That is a massive difference. So know what funds you're investing in, and the difference it makes over the next 20-30 years. Check the historical performance, so understand the ups and the downs of the market. This helps you to understand the risk that you're taking. So somebody who's coming close to the retirement age may not want to be 100% into stocks and shares. You may want to transition across to bonds, for example, because during the COVID 2020, the markets crashed by nearly 30-35%. So, be willing to accept the risk that you're taking with your money. Choose a fund that aligns with your goals. So make sure, like we said, you may want to go into a target retirement fund, which basically invest into 100% stocks and shares. And as you gradually move towards your retirement age, the funds then dilute it down with bonds, and you get less risk. Thirdly, things to consider is the assets under management. So the higher assets under the management means the more established and the lower the cost of these funds are because of the scale of economy. So that's it for this video. Thanks for watching. If you want to check my journey from January 2024, I will be investing £100 into stocks and shares, ISA in S&P 500. So tune in. Thank you. Happy investing. Bye.